Alright, how's it going? This is John Watkins, and I'm going to teach you guys how to do supply and demand zones. So basically, it's an intraday trading strategy. This wouldn't really work for swings. And just to quickly, I'm just going to the basics. The concept is institutions move markets. These zones are created because they have large buy or sell orders waiting to be executed. Institutions move the markets. That's your edge. You're never going to be able to predict what's going to happen. You have to understand that big money they know what they're doing, and they will push you out of your stop loss and bankrupt you, you know, just to go buy Nobu. So you gotta be smart, and you gotta follow their momentum and understand how the market's moving based off of what they're doing. So a supply zone is where large sell orders are waiting to be triggered. Usually it would be above, and then a demand zone is where large buy orders are waiting. All right, because Billy hitting the ask at 1,000 shares is not gonna move the market. But I'll just go on to show you. Here's like a 1 hour demand that I drew. There's a bunch of orders sitting here. So this is a basin candle. Basically, buyers and sellers are agreeing on price, right? When you need for demand zone, you're looking for a sharp candle up, and then same thing with the supply zone, you want a sharp candle down. It goes up so quick that these orders are waiting to be filled. So when the stock moves back down, these orders get triggered. These large orders that are buy orders get triggered, pushes it back up. And you can see here it bounced off this zone twice, went back up into new highs. So let me go in for an example, and I'm actually going to delete. I make them gray when they're invalid. You actually have to draw all these in, and the longer a stock or ETF spends time in the zone, the more it is invalidated, because there's less orders there. So I'm actually going to remove this, and I'm going to show you actually what I did. And I believe this was a 3 hour zone at the time. Yeah. So here it is, basin candle. And also I want to note too, typically these drops are better, or the pushes up are better when it's during market hours. So like right here, you could technically call this a supply zone because you have this large drop, but it's in after hours and pre-market, so it's not quite as valid. But basically, when you're drawing these zones, you take the big candle, the rocket ship candle, you go to the one before it, and you just want to go in the corner, and you're going to add drawing, rectangle, and you're going to push it up, and I'm just going to do it right here. And I'm going to zoom in, and I'm going to pretend like we haven't seen the next day yet. So I'm doing this, the morning of, and basically to edit it. If you don't edit it, I'm going to show you what it looks like. It looks kind of bright, and I don't like it. So you just go to color, and you're gonna click more, and you have to go over transparency, and you have to go through all this, and you have to type in 3 hour demand, and that's just the way it is. You can't get lazy, or you're not gonna make money in the stock market. That's the way it is. And then if you want to extend it, you just go to the bottom right point, and you just put in the date, and then you can see it right here. It'll extend out. So let me show you the power of this. So let's go into the 1 minute. All right, here's a SPY, and I'm gonna zoom in, and we'll go right here. Okay, you look at this. I think I took a put like right here or right here, and I sold it because I was approaching this demand zone. Look at this chart. This is basically, you got a head and shoulders right here. It's below the SMA. It's making lower lows. It's making lower highs. And you look at this giant candle drop, and you might freak out. I'm gonna sell. I'm just do EMA indicator. Everything's bearish. It's below the VWAP. Oh my god! You're selling into a demand zone that you don't know is there. You gotta ask yourself who you're selling to. You're selling to buyers, and these are institutions just gonna buy up your orders and run the stock back up. And you know what they're doing with your discounted shares? They're buying Nobu. We want you to get the Nobu. So if you're going short, this is technically where you'd want to get out. And you can see what happens. Boom. Rejects that zone perfectly. Goes back up, comes back down again. Now it's hanging out in this zone. Now I want you to understand too, this is a zone. So it's not like a support and resistance. It's okay if it hangs out in this zone. This doesn't mean that it's getting rejected. But you could technically either A, take a long out of speculation that was going to go up, or you could wait for confirmation. You can see that it pushes up here. This is a defined risk. So if you're in a demand zone and you want to go long, what you do is you go long and you set your stop below the zone. So if you went long right here, and then this happened, you wouldn't sell because it hasn't gone below the zone. And then look what happens. The stock goes in, this is where the SPY, the ETF, goes in to make brand new highs on the whole day, just barrels, rocket ships up. Chicken nuggets for everyone. That's why this is an important thing, because I always, and we've all done it, and I hear it. Everyone's like, "Oh, every time I sell, the stock just shoots up." Yeah, because you sold at a demand zone. You know, you're probably sitting in your long or your option, and it's so you're just sweating because it's just dropping and dropping and dropping, and this is where you end up selling. And you know, you usually wait. You know, you hold on as long as you can, and you can't take it anymore, and you sell. You take your loss, and then the stock goes back up, and you're like, "What the hell?" So this is why the demand zones are good to draw and good to have, because you can at least recognize where a stock may go up. And again, these aren't exact. It can still go down. I'm going to show you an example in the NASDAQ. So here's a 4-hour demand. I'm just going to remove it, and let's go to the 4-hour chart. And you just go down the list too. I go down from the day, 3-hour, 4-hour, 2-hour, 1 hour. The larger the time frame, the more accurate it's going to be, but you can use 5-minute, 10-minute. And if you get a 10, 30-minute, 15-minute in an hour, if you have like multiple demand zones and demand zones, it just validates it more. So let's go right here. So here's, I'll show you in the bigger chart. Here's a supply zone. Here's a giant candle that's gone down. Here's a basin candle where it's pretty much equal. And on the supply, you just same thing. You go to add a drawing, and you go to the right at the top of the candle, and this is, and by the way, I make it gray when it's if it's hung out in the zone. So that old SPY one I made gray because it hit that zone, so some buy orders were triggered. So I just keep it gray, so in the future, if it does come around that zone, I know that there was a zone there, and it's just not as strong. So for this, for the supply zones, you go pink, and same thing, go make it transparent. You're going to type in 4-hour supply. Now check this out. Let's go to the 1 minute. Look what happens here. All right, here's the I'm Vegas time. All right, here's the market opens right here. Already rejected it in pre-market. Market opens 6:30 here, and pretty spectacularly, it bounced right here. Rejected it. Does this? Rejects. You can go short right here, and again, you go short right here, and you would put your stop loss at the top of the zone. But look at this drop though. If you went short right here, I mean, that's steaks. That's steak dinner. That's chicken tendies for everyone. That's a thickie. I mean, this is you go short QQQ, go short NASDAQ, and there you go. So it rejected this zone. So if you're trading and you're watching it, and it's 6:30, we're consolidating, right? Buyers and sellers are agreeing on price. We have no big move. It hits this zone. You can go short right here, and you just put your stop loss up here, and it's a defined risk. And this is what? This is 258 to 285. That's like a 28-point risk, all the way down to the low of 1135. I mean, that's literally like almost like 230 points. That's insane. I mean, that's great. So that's the supply, and then I'll just show you a example on Facebook. Facebook had these massive push-ups last week. So I already drew one right here. Here's the demand. Here's the demand zone. So just to show you like an ETF, a future, and then here's a regular stock. You just go to the top and edit the properties, green. I know it's looks tedious, but you just got to do it. It's worth it. And I'm going to go and make a 4-hour demand zone. Now, Facebook's already kind of dropping down. I'm going to be watching this demand zone. And I just hover over it too, and you can see it, 4-hour demand. I'm going to watch this demand zone on Monday. And, we'll see if it bounces off, and you can go long, and vice versa. So anyway, that's just the basics of supply and demand. And, you'll get better drawing them. You just keep practicing, and you just go down the line. So this is already an hour zone. You can draw. This is a 30-minute supply right here, right? I'm on the 30-minute time frame. We have this giant candle pushing up, and then there's the small red box. You just would draw it in here. So this is a really good zone. So if Facebook starts to fall down, this is going to be a strong support for Facebook. Anyway, it's John Watkins. See profit, take profit, and have a good day.